The sell order went through at 9:43 a.m. in Beijing. $18.9 billion in U.S. Treasuries, liquidated quietly. Within minutes, a Bloomberg terminal in D.C. flagged the move. By noon, China's total U.S. holdings had fallen below $765 billion, the lowest level in 14 years. No official gave a reason, but the timing was impossible to ignore. 12 hours earlier, Donald Trump had taken the stage and threatened a 50% tariff on BRICS countries, dismissing their growing alliance as a fading joke. That same joke had just settled $855 billion in trade with China, entirely in local currencies. No dollars. No New York clearing houses. Just digital yuan, rupees, and rubles, circumventing a system the U.S. once assumed no nation would dare abandon. According to China's General Administration of Customs, trade with BRICS rose 3.9% year-over-year. In a year when global trade was allegedly shrinking, that raises a simple question. If the dollar remained untouchable, why was China offloading U.S. debt and stockpiling gold? Because treasuries no longer looked like a safe store of wealth. Moody's had just stripped the U.S. of its last AOA rating. Treasury yields surged 4.5% on 10 years, 5% on 30 years. But rising yields didn't restore confidence. They signaled distress. A government that couldn't finance its deficits without paying emerging market premiums was, by any standard, no longer risk-free. Japan took notice. Once holding $1.3 trillion in treasuries, it too was quietly cutting. Yet somehow the UK's holdings surged, surpassing China's for the first time. That spike, however, warrants scrutiny. According to FT analysts, much of it came from intermediary purchases, custodial flows that obscure the real buyer. If China and Japan were stepping back, someone else had to be stepping in. The mystery buyers? Other G7 nations. Effectively, America's allies were propping up a financial system that was now punishing them with inflation, and doing so while being publicly humiliated. At a joint G7 presser, Trump claimed Europe owed the U.S. for 75 years of defense, warning the bloc that they'd face the same 15% tariff floor unless they matched Japan's level of cooperation. What he meant by cooperation became clearer hours later. A $550 billion Japanese investment fund, destined not for trade, but for rebuilding American industries. Semiconductor plants, critical mineral hubs, pharma factories, all on U.S. soil, all paid for by Tokyo. What began as a trade dispute was morphing into something else entirely. This wasn't about tariffs anymore. It was a pivot from financial diplomacy to transactional extortion. Europe, now facing the same threats, found itself cornered. The EU agreed to a 15% flat tariff rate, down from 27.5% on cars. But buried in the fine print, according to Bloomberg sources, was a provision for innovative financing mechanisms. In plain terms, cash. The irony cuts deeper. The UK, Germany, France all still hold hundreds of billions in U.S. bonds. By funding U.S. debt, they are financing the very trade war being waged against them. According to Treasury data, 30% of all U.S. treasuries are foreign-owned. That leverage, once seen as a nuclear option, now acts more like a boomerang. A mass sell-off would spark global panic. But holding exposes them to a declining dollar and rising yields, a lose-lose scenario that only China seems willing to escape. Pause here because the center just gave way. For years, America's power rested on its balance sheet, global trust, safe assets, and dollar dominance. But today, its allies fund its debt, its rivals buy its gold, and its president is turning trade into a pay-to-play racket. The contradiction isn't subtle, it's structural. China's shift to gold isn't symbolic, it's strategic. The People's Bank of China has bought gold for 18 consecutive months for the World Gold Council. Simultaneously, Chinese miners are expanding globally, recently acquiring a Kazakh gold mine projected to yield 5 tons annually. IPO filings in Hong Kong are surging, with Chinese gold companies seeking $2 billion in fresh capital. This isn't diversification, it's replacement. And while China sheds U.S. debt, it's not pulling out of the global economy. It's reorganizing it. At the most recent SCO summit in Tianjin, a proposal was unveiled for a digital trade platform among Eurasian economies, with no dollar involvement. If it succeeds, it could challenge SWIFT, not with blockchain hype, but with state-backed infrastructure. Meanwhile, Washington's posture grows more aggressive. According to Commerce Secretary Howard Lutnick, the goal is to extract Japan-style investment pledges from Korea, Canada, and the EU. Korea, facing a 25% auto tariff, is reportedly weighing a $400 billion commitment. European negotiators, speaking to Bloomberg off record, admitted Trump's team threatened a 30% levy unless substantial equity participation was pledged in U.S. infrastructure projects. Scott Bessent, now Treasury Secretary, defended the model. The U.S. can't afford to borrow at 5%. So if allies want better rates, they can help us build. His framing was innovative. The outcome? Forced subsidization. And here's the second irony. The U.S. once criticized China's Belt and Road Initiative as debt trap diplomacy. Now it's demanding capital from allies to avoid issuing more of its own. Meanwhile, BRICS keeps expanding. According to Chinese customs officials, trade with member and partner nations now makes up 28% of China's foreign trade. That's not marginal, it's systemic. And the products involved aren't soybeans and t-shirts, but chemicals, processing equipment, and industrial machinery. This isn't a club of poor nations. It's an industrial bloc forming without Western mediation. Trump, however, sees no threat. BRICS wanted to take on the dollar, he said at a Washington summit. We tariffed them 10%. And nobody even showed up to their meeting the next day. But that statement contradicts U.S. Treasury reports. China's $855 billion in settlements with BRICS didn't decline, it increased. Trump may be winning press conferences, but he's losing positioning. U.S. industry is already bleeding. The ISM Manufacturing Employment Index fell to 48.5 in May, the fourth straight contraction. Industrial jobs are down 82,000 this year. And while the White House continues to promote reshoring, the cost of reindustrializing with imported raw materials is skyrocketing. Copper, aluminum, and rare earths, mostly sourced abroad, now come with tariff premiums of 30% or higher. These are input costs that American manufacturers can't absorb indefinitely. Which brings us to another contradiction. The Trump administration wants to bring industry home, but refuses to remove inflationary friction. Higher tariffs raise costs. Higher costs depress demand. Lower demand kills jobs. And unlike in 2018, the Fed has no room to help. Lowering rates would crash the dollar. Raising them further would sink the bond market. Enter the foreign financing workaround. Japan's $550 billion was only the beginning. Bessent's office is reportedly structuring similar packages with Canada and the EU. But Canada is dealing with a housing crisis, and Europe, cut off from cheap Russian gas, is economically limping. As Bloomberg reported, German manufacturing is already in a technical recession. France is facing 9% energy inflation. These aren't surplus economies. They're deficit governments being pressured into funding U.S. capital formation. And what if they say no? Trump's team has already previewed the response: escalation. A 50% tariff looms over BRICS. Brussels is drafting a 30% retaliatory list targeting $17 billion in U.S. exports. If enacted, it would mark the most aggressive Western-on-Western trade breakdown in modern history, more intense than Boeing versus Airbus, more combative than the steel and aluminum disputes. Because this time it's not about trade, it's about investment. And behind all of it lies the U.S. Treasury market, the quiet core of global finance. According to March data, foreign holdings of U.S. debt hit a record $9.05 trillion, even as China pulls back. Which raises a troubling question: who's still buying? And what happens if even they stop? If G7 central banks start tapering support, the U.S. faces three options: print, default, or beg. None are politically viable, but all are now conceivable. Negotiations with China resume July 28 to 29th in Stockholm. Bessent will attend. So will Lutnick. The official focus: agriculture, cybersecurity, and sanctioned energy purchases. But privately, the U.S. wants something else: to stop the bleeding. To get China to stop selling treasuries. To keep the system intact. Yet there's no indication Beijing will comply. From China's perspective, the logic is simple. Holding treasuries means financing your rival's trade war. Buying gold means shielding your economy from it. Building trade networks outside the dollar means eventually making those trade wars irrelevant. The playbook isn't hidden. It's unfolding in plain sight. And it's working because the retaliation is already priced in. So as the West juggles recession fears, bond market instability, and populist trade policies, the global economic order is realigning. One sell order, one tariff hike, one contradictory summit at a time. The financial war isn't looming. It's already on the books. And maybe the real twist is this. The United States, once the architect of a rules-based global economy, is now testing what happens when the rules no longer work in its favor. But in doing so, it may uncover a darker truth. That rewriting the rules doesn't make you stronger. It just exposes how much power you've already lost.